Hi, I'm having a pretty bad time at JFK. Actually, it's been pretty hellacious. The airport's just so packed. It's incredible. And of course, you've got all these air traffic delays. Anyway, we're looking pretty good for, you can't see it, but this trusty JetBlue flight, economy to London, a couple of $100 for extra legroom. Pretty brutal. And generally speaking, the flying experience is pretty tough at the moment. Combined with the prices, which are just huge, just can't help but feel that maybe we're going to see a slowdown in air traffic as basically as the expense and the misery of the experience kicks in. But we'll see. I guess I'm just not super enthusiastic about this trip to London. As I've written in the research, basically it's a mercy mission to go back and see my mom, who's pretty bad. She's been in bed for a couple of years now, so it's not a shock, but it's not exactly a fun trip, this one anyway. It's Wimbledon, and there's a couple of other things happening. I can go see Billy Joel in Hyde Park on Friday if I want to pay $300 for that, which I doubt I will, but we can hear it from the apartment, so that's that. Anyway, getting to oil, interesting this morning, hearing that Russia, who knows with Russia, but they're saying they're going to cut production more. We've said that several times before. But more importantly, Saudi has said they'll extend their cuts through August, which was one of the open questions because originally it was just a July cut. At the same time, though, you read a headline where Saudi and Algeria are cutting their official selling prices for propane. And that's really been the key to what has had us bearish for several months now, has been this NGL propane market weakness, which really speaks to primary weakness in the economy. So whilst the service side of the economy, which is people flying, is obviously going very strong, it's really driven by excess savings, and we're just concerned that once you work through the excess savings and you combine that with inflation remaining high, unemployment low, the Fed's going to have to stomp on everything harder, and that should combine into what we think will be a pretty bearish outlook for the second half. But if they can address the supply side, which is obviously what the Saudis are trying to do, who knows what the Russians will do. We think it's very difficult for them to cut volumes of exports when they're so dependent on export revenue of oil. If all these things come together, then the problem in the market is the supply side, because although demand has been a bit weaker in China, essentially we're at 102 million barrels a day of demand globally. I mean, it's an epically high number. And that's why long-term we're so bullish oil, because you're just seeing such huge quantities of overall demand. All of our call is basically short-term cyclical into a recession in the US, and we want to get to the bottom, which is really a target of $60 a barrel sometime early next year, before we start thinking about weighing back into these things, especially as we head into earnings season, where we think there could be some negative surprises from the refiners. We talked about that in a long note about Valero on Saturday. A lot of things going against them right now, not just the NGL prices, but also for example, the differentials, the heavy light spread, the sweet sour spread, all of those things are very tight at the moment and will stay tight. We believe they're actually quite structural shifts. For example, if we roll over US production, which arguably is what the market's trying to do, so the way the market works is it's going to go after the marginal excess barrel. And really at the moment, the marginal excess barrel with the most price elastic supply side is the US, which is why you see rig counts falling and why they have to fall more. Because once we start to create US production, that's when the bull run is on. And the mega bull run is on already, because once productivity starts falling, which essentially it has, then you're in a 10-year, 20-year bull cycle, and that's going to be very powerful. So it's an unfortunate call. I hate making it where you're like bearish short-term, bullish long-term, and we'll see. And furthermore, there's a shot. The Saudis, of course, they have a shot of tightening the market successfully. We published, for example, 9-point Eric Nuttall inventory chart yesterday, which shows massive tightening of inventories over the second half. The only issue is that we're in the second half and inventories are still rising. Particularly, we're highlighting the Saudi floating barrels in the Red Sea, which are an obvious excess of oil and are stacking up at quite a rate. The Bloomberg story had 130 million of floating storage out there, which is very bearish, obviously, for the market when there's oil just sitting on tankers that can't be used. So that's about that. I'm just trying to think what else there was. Yeah, and the Valero note, we just went through the fact that basically the company is excellent, the management's excellent. It's just there's headwinds going into the second half, and people are talking about refining as a place to hide. And what we're saying is refining is no place to hide in a recession. If the Saudis squeeze the oil market higher, it's going to be bad for refining. If the market can't be squeezed higher, it means weak demand, and that's going to be bad for refining too. So we're quite negative on the refining. Not so much Valero, but some of the other guys, maybe a PSX or a Dyno. I think we felt may have a tough time. PSX is very much a play on the global GDP picture with its petrochemicals, and as a result, somewhat bearish there. Dyno struggling with renewable fuels. Another bearish thing for refining, by the way, and there's a list in the note of about 10 things, is of course the penetration of renewable and biodiesel into the oil balance in the US. I'm boarding my plane and I'm going to go. Wish me luck. Have a great week. Thanks.